Forward price. A forward price is a certain contract which is connected to the delivery price, which would make that contract have a zero value. The forward price and the delivery price are therefore equal at the time the contract is entered to. As the time passes, the forward contract is liable to change while the delivery price remains the same, for the two are therefore not equal except by chance. So for example, at initiation the price is set to 1.2, and at delivery the price is set at 1.4, and the actual is 1.3. So regardless what the actual price is, the delivery will always happen at this price at the maturity date. Generally, the forward price at any given time varies with the maturity of the contract being considered. For example, the forward price of a contract to buy or sell in 3 months' time. Now this could be buy or sell. So the contract could be either to buy or sell. Is different for the contract for 6 months' time, because the other party will have a different understanding of a different time period. So for example, the price at the spot could be 1.72, and 30-day forward could be 1.7208, and 785, and then 90-day forward it could be 1.728 or 90, and so forth. Now the companies frequently enter into forward contract on foreign exchange. So for example, pound to US dollars exchange at one date could indicate that there is a commissions and transaction cost, and the spot market for it to be virtually at the rate XYZ, for example, the quote, you can see that this is increasing. So one can say that the one of the asset is weakening and the other is strengthening. At the payoff, there could be a positive or negative depending on how much money required to enter into contract, and the payoffs from the contract is also from the investor's total gain or loss from the contract.